Thank you for watching this YouTube video on first-time home buyers and the loan process. I have a loan professional here, Ben Shelbourne with Cross Country Mortgage, to be our expert of reason for today's show. And Ben, I'm just going to dive right into it here and ask you the first question. What are some common misconceptions about being a first-time home buyer in a mortgage?
Hey man, thanks for having me. I guess the first one always for me is how much down you need. You know, a lot of people, they save and they save and they save for months and months and years, and they think they need the 20%. In reality, you can put as little as 3% if you're a first-time home buyer. And I think the beauty of that, it leaves a lot of money available for things like repairs and renovations, just remodeling when you get into that first home. So, you know, anybody that's waiting a long time to save that kind of money, they're probably missing out on the equity in the home that could be building over the years they could be in the home. And that's huge, you know, because in that time also, you got to remember you're spending money on someone else's mortgage and your rent payment.
Right.
Yeah, I guess that's the first one. Second one is credit scores. You know, everyone thinks they need a perfect 800 score and above. And in reality, you can get an FHA loan, which is a government insured loan, at a 580. We actually do a 500 credit score. The only difference there is you do have to put a little bit more down to mitigate against the lower credit score in terms of risk. But you can go as low as 500 if you are truly looking and you really want to take that next step. It just allows a lot more people to get into a home that think they can't. And people spend a long time, more than necessary, building these steps when in reality they probably get the home they want without having to do too much work.
Got it. Well, that's great information. Thank you very much, Ben. What type of programs are out there for first-time home buyers?
Well, the first one I mentioned, FHA. You know, that's a government program. It's government insured, and with the down payment for that's 3.5%. A lot more leniency with your debt to income ratio, which is how much you owe per month on all your debts, including the mortgage, versus what you earn on a yearly basis and a monthly basis. So as a first-time home buyer, if you are stepping into this process, it gives you more flexibility. That's all. So lower scores, higher DTIs, which are really good starting points. And, you know, don't forget, you can always refinance into different loans later on. I guess the next one would be conventional. Conventional is just private equity loans by Fannie Mae and Freddie Mac. And without going into too much detail, it just means that the loan would be insured by Fannie Mae and Freddie Mac, and you have to put 20% down to drop any mortgage insurance. So that's where people get that 20% common misconception is, I have to start here, otherwise I can't buy a home. Now, you can get rid of mortgage insurance by having that 20% down payment when you first get into the home. Anything less than that, you're going to have to pay a small amount of monthly mortgage insurance. Again, you can refinance, get out of that. And the mortgage insurance is to protect the loan and the home. It's for foreclosures in case that happens, in case you don't make payments. If something happens in life, it's there to protect the loan itself from the bank who's invested.
Got it. So what you're saying there is you can still do a conventional loan for less than 20% down payment. Is there like a 3% conventional loan, 5% or 10%?
Yeah, that and all the above. So it starts at 3% for a first-time home buyer. And the definition, just so you're aware of first-time home buyers, anyone that hasn't owned real estate in 3 years. So you could have owned a home years ago, you know, 5 years ago, and you still qualify for a first-time home buyer. So again, if you are trying to save a lot of money, or if you want to save some of that money for a cushion, you know, your reserve funds for starting your loan for that safety net, you can put 3% down and have the rest for other things. If you have owned a home in the last 3 years, it just jumps to 5%. So it's not a huge difference.
Right. And to add a little experience to what you just said there, my wife and I actually bought our first home, 10% down payment. Interest rates were low, and then the housing market boom took off in the San Francisco Bay Area. I think it was within 8-9 months we were able to refinance because our home appreciated that fast. where we were able to get off that PMI payment. We were able to save about
Yeah.
$400. Actually, no, I think it was like $500 a
Wow.
month just on that PMI that we were paying. So
yeah, it can be that significant.
Excellent. Ben, is there any other loans that coincide with that?
Yeah, I mean, you've got VA loans, which are for veterans. There's no down payment on that. It's already insured, the loan by the VA as well. Obviously, the benefit there is you go in with 0 down, so you don't have to save that money. You just get straight into a home and just have to cover your closing costs.
Mm-hmm.
The other one is USDA, which isn't massively popular. It's for rural loans. And again, these are 0% down, but you are very out in the woods style home, typically for farms, stuff like that. Other than that, the next step up is to mortgage amounts that are higher than the county limits. What I mean by that is each county has a limit on how much money they will send out to somebody before jumping into different categories with more risk. So the next jump up is high price loans, then jumbo. And jumbo, again, you can easily Google these amounts in, a quick search saying, so-and-so county, let's just say San Diego, for example, San Diego County, loan limits, jumbo limits, FHA limits, and it'll tell you what those loan limits are before they jump into the next category.
Got it. Well, that's awesome. And what are some of the pre-qualification factors for some of those loans that you mentioned? I know you referenced for the FHA loan, you can sometimes get down to 500 as far as a credit score. I imagine that's different with these different loans. So I'll let you take over from there.
Yeah, exactly. So you can go as low as 500 as long as you're putting more money down. The real cap is 580, where you can still put 3.5 down as long as you do have strong enough credit history. The next step up from there would probably be a 620, which is still FHA, but it's getting you a more reasonable rate. Into conventional, you're looking at about a 680 and above, between 680 and 720. 720 and above, you're then looking at jumbo categories. So you do have to go up in your score if you are trying to borrow more money a lot of the time.
Got it. And lastly, Ben, how does a borrower qualify for some of these loans if they haven't even started the process yet, but it's something they are planning to do?
So obviously the credit score we've discussed, work history, just need a minimum of 2 years. And that has to be in a specific area. And what I mean by that is either W-2 or self-employed. So if you, for example, were doing a W-2 employment for Amazon, you're working at Amazon, and then all of a sudden you went self-employed and started selling your own products, you reset. So you're going from 0 to 2 years again as a self-employed person, and vice versa. So 2-year history is really important. You can swap jobs in the same category of W-2, self-employed is self-employed. The 2-year history is really important. You can have gaps of employment as well. FHA allows, I believe it's 6 months before you have to start working for an additional 6 months and use your 2-year history prior to that. Self-employed, you just got to be, tax returns, send those in, see what the averages are for 2 years. Photo ID, just so we can, verify names, date of birth, that kind of thing. And pay stubs if you're W-2. So these are the minimum requirements to send in a mortgage application. And from there, there's a lot of different styles of loan, a lot of different ways to qualify people. So it gets more complicated from there, and going through it will take a lot of time.
Got it. Well, thank you very much for your time, Ben. I think a lot of questions were answered. For anybody who's looking to get pre-approved for the first time, we should definitely follow up with another video about the qualification process to be underwritten for when you actually get into contract for buying a home, because I'm sure there's a lot more information that you can provide for us. But once again, thank you very much, Ben. Cross Country Mortgage. I'll make sure to put your contact information, your phone and email down below, and I hope that you can answer a bunch more questions that maybe we missed in this segment. So thank you once again, Ben.
Yeah, thanks, John. If anyone has any comments to leave with specific questions, that could be a next trail into our video.
Perfect. All right, Ben. Have a great day.
Thanks, man. You too.
Bye.